recording in progress, so feel free to do your intro.
All right, excellent. Thanks for that, Purdy. Good morning, everyone. I hope everyone's had a great start to this program and is looking forward to learning and growing. I'll start by setting the context in terms of my own journey and a little bit of sort of the sorts of things I've had experience in. So I've been in fintech for over 20 years at this point. I started my career in investment banking technology at Goldman Sachs. And that's where I really cut my teeth in strategy and product and just kind of really building software for financial services. I was there for 11 years, so really, really long time. I then made a choice to move into the startup side of fintech, so the actual sort of venture-backed businesses in the fintech space, and that's where I've been operating in for the past 12 years. And over these 12 years, I've been in 4 startups, twice as a founder and twice as an early employee. So really like one of first 10 people to join the founder who had started the company and kind of really work as an extension of the founding team. So both as a founder and as an early operator, obviously the nature of the business is that I've worn many hats. But my own kind of sort of specialty still remains raising investment, so investment readiness of a company combined with strategy and product. So over the 4 startups that I've been with, I've raised capital multiple times. I've done a crowdfunding campaign for one of these 4 startups that was really successful. One of the other startups, I led an initial coin offering or ICOs. So those of you who were around to watch the craze that existed in 2018, 2020 with all the blockchain-based or digital currency-based companies raising money via digital currencies, so sort of the Bitcoin, Ethereum way of raising money was big. So the company I was leading as the CEO at the time raised around $14 million via an ICO. And then for the other 2 startups, I've done equity raises with angels and VCs. So really have a pretty holistic view of what the investment raising landscape looks like and have a lot of war wounds to show for it. I closed my last company. So out of the 4 companies, one of them is a growing concern, 2 of them had an exit, and one of them has been, what classically would be deemed as a failure, which was the last one. I closed my last company because just given the market, we weren't able to raise our next institutional round, which would have been something between a seed or a Series A. And sort of on the back of that, I am right now focused on sort of channeling all my learning, my experiences, and my insights to enabling founders such as yourself. So I spend a lot of time working with founders, either via programs such as Hotbed or directly with companies themselves, just kind of supporting them on their investment raise journey or supporting them in terms of kind of getting a grip with their product and strategy.
Awesome. Thank you so much for the introduction. And just for Priyanka, but also for the wider community, everyone that is joining the program has either raised a friends and family round or a pre-seed round, or has at least 100K in revenue over the last 6 months. But just out of interest for the founders in the room, and everyone's fundraising again, how many of you are going to be raising for the first time from people that you don't know? So your pre-seed round or friends and family round, you are raising it from real friends and family that you already had good relationships with, and this is the first time that you're going out either to angels or angel syndicates or VCs, but you have to build the relationship from cold, because that's what we're going to be covering today, kind of how to build that trust with investors when you haven't got a pre-existing relationship or you want to just keep the relationship going. Okay, cool. That's useful to know. So that's pretty much what we're going to get into. So that question, just to start with, from your experience, what is the best approach to building those relationships if you have no pre-existing relationship and you're going to be fundraising in the next 3 to 6 months? What would be your recommendation for both for kind of investors that you want to ideally have contribute to this round, and then maybe investors that would be better for a future round, but you're trying to balance whether you start the relationship with them now or you hold off until you're in a better position to raise from them in the future?
Yeah, and I think that's a great question as a jump off point. So like one of the things I would say about building relationship is, and I say it with a lot of sort of personal experience and strong conviction, that it's a process. And I think one of the things that I see a lot of founders not kind of recognize and therefore not act on it is that building a relationship takes time. And the first thing to do is to start as much in advance as you can. I'd say up to 6 months in advance from the time that you actually need to be having sort of, pitching and having term sheet related discussions with the investors. Because one of the things to keep in mind is that investors are perpetually inundated with people reaching out to them. And for you to be in a position where they actually start to recognize either sort of your name as a founder or your company's name in terms of, what you've set out to build or what your kind of vision is, you're going to need multiple touch points, right? So this kind of goes back to why you have to start early. So you're going to need multiple touch points, which then again kind of, needs you to have started enough in advance. So you give yourself that lead time you need to either send them email every other week or initially once in a month, and then kind of pick up the cadence as your fundraising milestone starts to kind of approach where you are versus where you need to be. So keep that kind of lead time in mind, and also kind of build up a regular cadence in terms of with what frequency are you going to be reaching out to these investors. The second thing I would say is there are two ways to think about it, right? When we talk about sort of building relationships with new people, it's about, have you been introduced to them or have you met them in an organized setup, right? So a number of you will get to pitch to investors as part of this program, or you might be part of sort of other communities where you'll have demo days and things like that. If you're meeting with investors in that kind of context, you already have a good start, because you're not kind of a complete unknown to them. They know where you're coming for, and there's a little bit of a credibility going in your favor. And from that point onwards, it's about the information you provide to them, and then how you upkeep that information, leading to a point where you can say, I am actually ready to ask for money and I'd like to pitch. The other thing, which many of us need to do, and I've kind of been there, I've done myself, is shortlisting investors or creating what's called like an investor hit list that's relevant to your business, and reaching out to them completely cold, right? So like completely circumnavigating any kind of warm introduction, either because you don't have any sort of common connection that can make that warm introduction for you, or there's this investor that you think is really relevant to your company, what you're building, but they might be outside of kind of any program, any support network you're in. And believe it or not, those kind of cold outreaches still work, right? There's a lot of I guess discussion around why investors need to stop taking warm introductions and entertain cold outreach, etc. And there are actually investors who do entertain cold outreach, and I speak this from personal experience. But the thing you've got to do there is make sure that the first note you write to the investors is highly personalized. So personalized not to you, but personalized to them, right? And almost, in context of, if you think of fundraising as a sales process, because essentially that's what it is. You're selling interest in your company, you're selling shares in your company in return for capital. Within the sales world, this context is called show me you know me, right? So if you are writing to an investor, what can you say to them in your opening paragraph, which is not me, but it's about you, right? So I'll give you an example. So in one of my startups, we did a cold outreach campaign. We reached out to about 2025 SEIS, EIS VCs who were very relevant to what we were building, but we didn't really have anyone in our network to make an introduction to. And we actually spent the time in looking at their portfolio companies. So every VC's website will list, if not all, a good number of their portfolio companies. And we looked at their portfolio companies to identify a couple of companies that were similar to us, either in terms of the industry or in terms of audience. So for example, if you're a health food company and you're looking at an investor's portfolio company and they have invested in healthy cereal, then you literally can craft a cold outreach that says, hey, I saw that you've invested in X, which is a healthy cereal company for kids. And given that, we thought you'd be interested in us because we are we make healthy cereals for people 60 and above, right? And you can see how making something that's so personalized to the person you're writing to this investor that you're writing to, gets them to take notice even before you've gone on to say, oh, I'm writing to you only because I want X, Y, and Z from you, which is actually something that doesn't work. And something that works even less is having a canned email that you send to everybody. So, if you are genuinely looking to make cold outreach, I cannot emphasize this enough. You want to personalize the note that you're sending to this investor, and you literally want to start by giving them a reason or two reasons for why they need to read rest of your email. Right? So this is around kind of, how you reach out to somebody cold. What do you want to say to them? And chances are you're not going to hear on the back of just your first or just a single email. And that comes back to all the investors are super inundated, lots of smart founders out there reaching out to them all the time. So then what do you do to kind of make sure that you get a response? And this is where the thing that's really important is having a process, right? So actually the ability to raise investment really comes down to how tight your investment process is. And when it comes to maintaining or managing these relationships, you want to have a process that you follow on a regular basis. So you set the cadence, and based on how far out you are from your raise, I initially recommend you start with a monthly update. So if you've sent your sort of, first email, which is just an outreach, you're kind of setting the context. And from there on, you want to get into once a month. And if you're sort of, more like sort of 3 to 5 months from your raise, then maybe every other week, by simply saying, I wonder if you had a chance to look at my last email. And by the way, since I sent that email, we have achieved X and Y. Two things. It could even be one thing. It could be this one sort of, LOI you've signed with the customer. It could be a beta app that went on Product Hunt. It could be a new marketing campaign you launched and you just want to say, hey, we just did a new product video. What do you think about it? Put the link about the video. So you definitely want to get into a place from a process perspective where they're hearing from you on a regular basis, because that's really the only way for them to, again, we go back to what's the goal. We want to be in a position where they recognize your name in their inbox as the founder. They recognize the name of your company as doing this thing. And the way to do that is to kind of keep reinforcing that, and you reinforce that with regular updates, right? So you kind of do that. And then the last bit, if you really are in a fundraising mode where you kind of, you don't quite have that lead time of building a relationship, getting them to maybe pick up on your email, say something, and then pitching. If you're like hard on fundraising pretty soon, then you still do all these things, but you kind of reduce sort of the gap between, how often you write to them. So what, could start with once a month, you're kind of down to, you send a message saying, we thought you'd be interested because of this. This is who we are. Can we have a 15-minute call or something very simple? Would you like follow-on materials so you can know more about us? And then you reduce kind of that gap to sort of 3 to 5 business days, right? So you send a second email in 3 to 5 business days. You send a third email in 3 to 5 business days. And the last thing, and I say this more from the perspective of kind of managing your own headspace, is you also want to kind of say, how many attempts will you make with someone before you park it, right? And I'm not saying you bin it forever, but before you park it and then you kind of come back to it, because given that all of you have raised in some form or other, you know that getting ghosted or not getting a response can be pretty soul crushing as a founder. And one of the very practical ways of dealing with it is saying that, okay, I do 3 emails or I do 4 emails with an investor, and then I, if I haven't heard back or haven't heard anything constructive, I move them to a pause list and then just kind of move on, because the reality is that at the end of the day, raising investment is the numbers game, right? So you just kind of have to keep moving through the list without your feelings and emotions getting in the way.
Yeah. On the numbers game thing, I was going to ask, do you know from a pipeline perspective, if you started with a list of X amount of investors, and then there's a percentage of them that might reply to your email, and a percentage of them that might take the call, and then a percentage of them that might end up going to DD, and then a percentage of those that write the check. Any
Yeah.
idea on what those numbers might be or what you can expect so you can work backwards and kind of reverse engineer the funnel? So you need to have a
Yeah.
list of 500 or something to start with.
Yeah, for sure. And that's a great question. So on an average, in my own experience and having kind of, been in discussions with other founders who've raised, you've got to have 20 serious conversations to raise about 1 million. Okay. So if you're trying to get to 20 serious conversations, which have gone past that initial pitch to we're actually taking a look, right? So you may pitch to a principal, if you're, let's talk fund structure. So I'm not talking angels, obviously. If you're talking, pitching to a principal or sort of an associate, and the next level conversation is a principal coming in and then eventually going to the partner who's going to champion you at the investment committee and things like that. So that kind of stage where you pass that, intro conversation and then someone wants to follow up, um, you ideally want 20 of those serious conversations going on at any point of time. And to get to 20 of those serious conversations, you're starting with a long list. People call it the hit list. I prefer calling it the long list, kind of is trying to stay away from that whole war and peace terminology that exists for founders. So the long list has to be about 80 to 100 investors.
Yeah, that makes sense. And in that initial email or the follow-up email, how important do you think the kind of KPIs piece is and the data? So you mentioned noting down a little bit of traction, like we've signed this LOI since last time. How do you make sure, or I guess what is it that's going to get investors interested? Because it might be a bit about the team, it might be a bit about just the product that you're building or the industry that you're building it in and how aligned that is with the investors. But if they're completely agnostic, which especially angels, a lot of them will just say, I'm agnostic. How do you kind of win them over with numbers?
So I'd say there are actually two things to take into account in response to that question. One is you do always want to lead with what is the strongest aspect of your business or your team, right? So in some cases, it actually might be the team why you're going to be the winning company, right? Because it could be a group of 2 or 3 founders. You come from the industry you're building in, or you've been at a company that operates in that space, but they're an incumbent, and you firsthand experience something that incumbents don't do so well, and you kind of have ventured out on your own. So it could be the team that kind of really is your biggest selling point. It could be the fact that you're early and you're already seeing some traction. So if you're in that position, then that's your sort of your strongest selling point right now, and that's what you want to kind of lead with, and that's where you can use some numbers. So the reason I'm kind of giving a couple of very different examples here is that in that initial email, you absolutely want to kind of, first of all, know amongst yourself what are the two, if not two, one, but like what are those couple of things that make you stand apart, that set you up for success, and how do you communicate that out even before you start thinking about numbers? Now, if what sets you apart is something like early traction, or what sets you apart is just the size of the market, right? Like you've identified problem in a space that has this ridiculous TAM, right? That's a number. So you're going after, what is a $3 trillion opportunity, right? So then that's kind of when you start using numbers. Now, obviously, an ideal opening email is something that has the qualitative and the quantitative. Uh, but in what's important to make sure is that in that opening email, you have to lead with what truly is sort of your differentiator, and then to the extent that your differentiator has numbers around it, so whether it's TAM, whether it's your early adoption, whether it's You launched on Product Hunt and you had, I don't know, 500 signups in the first 24 hours. Whatever it is, that's the aha about you. That's what you put in that opening email.
Yeah. And then with the follow-up emails, any idea on what KPIs founders might want to focus on? Like if they're like, I'm just going to focus on having customer conversations or increasing the amount of sales calls that I get or going after LOIs, or we're kind of asking founders to stay accountable to themselves by focusing on one or two KPIs over the rest of the program. So do you have any idea of what, from an investor perspective, the best thing that you could kind of like buckle down on would be?
Yeah. So, again, if you think about this from an investor perspective, what an investor wants to know, what any investor and every investor wants to know is the proposition that you're presenting to them, is that bigger than your personal view on that problem or on that proposition, right? That's what they're looking for. They're looking for, what I call proof of demand or proof of gap in the market, right? You can, however you want to think about it. So when it comes to, so that's the first thing actually, and then the second thing is it's your ability to monetize that opportunity that you've spotted, right? So those are the two things up front that an investor wants to see a lot of sort of data around, supporting proof points around. But at the end of the day, they're trying to answer two questions, which is the gap that you've identified in the market, is that for real, and is there a market in that gap, right? So when you start thinking about your business from this lens, from these questions, then you can come up what KPIs or what sort of metrics or sort of numerically, right? Because qualitative is subjective, quantitative less so. So from a numbers perspective, how can you answer that for the investor? So if you are sort of, again, depending on your B2B, B2C, and where you are in your sort of product or service development journey, in terms of you showing proof of demand that there's really a gap in the market, you want to identify any kind of early signs of showing that gap in the market. So it could be things like how many downloads your app has had. If you're a B2B, then how many active POCs you have running with your prospective customers. It could be LOIs that you have signed. So if someone gave me the money and I build this product, here are the 5 enterprise customers, who are ready to start piloting this. It could even be how many waitlist signups you've had, right? So you've put something out there and you've asked people interested in the product to put their name on the waitlist, right? So the fact that someone's actually taking the time to give you all their information, again, proof of demands. People want that service, which is why they're getting onto their waitlist. But essentially what you're doing in the first category is you're identifying metrics that for yourself, as much as for your investor, help you objectively demonstrate and prove that this gap that you're going to commit kind of your life to over the next 3 to 5 years is a genuine gap in the market. And then you come to the second part of it, which is to say, how am I going to monetize it? And do I have any metrics right now that can be shared to show that early sign that there's actually money in this gap, there's market in this gap, right? So for example, again, if you're doing LOIs, if you're doing POCs, have you discussed pricing? Right? And can you include that? So if you're a B2B business and you're running a POC, which might be free initially, or LOI obviously has, no money associated with it, but can you kind of, make that LOI more comprehensive by saying that, and we have discussed pricing this on an annual license basis in the range of 10,000 to 20,000, right? And then all of a sudden gives you something very tangible to say, we've got 5 customers that have shown interest, and we are exploring, pricing of around up to £20,000 in annual contract value, right? And same thing, right? If you could be a subscription-based app. If you're doing customer surveys, if you're doing wait lists, can you extend that a little bit to say, oh, if this service existed, would you be willing to pay for it? Yes or no? Okay, you'll be willing to pay for it. Would you pay up to £3 for it, up to £5 for it, up to £8 for it? So you're thinking of what you can collect from your customers, again, right, to show that they really are interested in this service, that it's a need that this product or service is going to fulfill, and that they will actually want to pay for it, right? And that's kind of what you want to bring together in these metrics.
Yeah, that makes sense. And just for the founders, as well as identifying one or two KPIs, we're going to be asking you every week how many customers or potential customers you've spoken to, because that's a part of the conversation, not only to, yeah, assess pricing, but understand what their challenges are, how you can market a product to them based on the language that they're using when they're talking to you about the challenges, to understand the competitive landscape and how they're currently solving that problem. So that will be something that we ask. And then we'll break it down on B2B and B2C and let you know how many customers that your fellow cohort members are speaking to. So you know if you're only speaking to one or two and everybody else is speaking to 100, that maybe next week you need to go out and identify some more people to chat to. So you can start validating that side. We are going to move to audience Q&A shortly. If you already have your hand raised, Adam and Rohith, I think it was from previously when I was asking about people raising for the first time from people that they don't know. So if you can lower your hand, but if you have a question, feel free to raise your hand again using that raise hand function or type it into the chat and I can read it out. So we'll move to Q&A in about 5 or 6 minutes. On the point of the metrics and kind of sharing that with investors, do you have any idea on what good actually looks like? Because I think one problem with the ecosystem is that founders don't really know what they're being benchmarked against. So they might think, oh, I've got, I don't know, 5K recurring revenue monthly, or I've got 25 customers, or I've got a wait list of 100 people or 1,000 people or 10,000 people, but they don't know whether that's actually, in the eyes of an investor, a really positive signal, or whether other people are coming with similar business models that have totally different metrics that are outperforming them, or that they're focused on the wrong thing. So any thoughts from you on what good looks like, either when it comes to growth or product or customer feedback?
Yeah, so I think the what you're raising is a genuine gap in the market, which is the fact that there isn't any reliable benchmarking data that's available to founders, and a lot of it really depends on which other founders are in your network, and to the extent that founders are willing to share some of this about their own business, because understandably during early days there is that slight reluctance to actually make some of these numbers public. So I haven't come across, or I don't think I've seen a large enough data set to say that, oh, if you're this stage company, 200 is a good number or 500 is a good number. But one thing that I have experienced, and in talking both to the founders and investors, know for sure, is that more than one number at any point of time, what investors are bought into more is the trend that you show over a period of time. Right. And this is also why, starting early, especially if you are sort of on your first angel VC raise, i.e., raising outside of friends and family, is a very good idea, because it gives you that kind of lead time to build that trend line in for yourself and in your investor's mind, and just kind of really elaborate so everyone understands it the same way. It's about the week on week growth or the month on month growth of the 2 or 3 metrics that you've set for yourself, right? So let's take waitlist sign up as an example. Now, when you start tracking this for that week, you may only sign up 20 people, right, on your wait list. Now, I think it would be safe to say that 20 isn't a big number if you are sort of that B2B2C or B2C type of a business, like an app, or some kind of a sub 20-pound SaaS, because a business like that just fundamentally relies on having like thousands, if not hundreds of thousands of customers, right? So 20 is a small number, but that's fine, because no one investor is going to get caught up on 20. What they're going to be looking for is, next time you send them that update, whether it's in a week's time or in a month's time, is how has that 20 moved? Because everybody understands, like every investor understands, is that it's about how you're building kind of, your GTM channels, the awareness about what you're doing, and how you're continually reaching out to your customers, and pretty back to your point about those conversations, and how much, as you're having those conversations, how are you converting those conversations into waitlist signups? So what I would recommend is, in the absence of, reliable benchmarks, what you want to be focusing on is showing that growth rate, because that's like the number one thing that separates, a high growth and therefore a well-funded startup versus something that's kind of bumbling along, but not showing the kind of growth that institutional investors or kind of really professional angel investors expect. So obviously you want the number to be as big as possible, but more than the absolute number at any point of time, always focus on, what the trend is, and make sure the line is to the up and the right, as they say.
Yeah, that's consistent with what we've spoken to some angel investors about who have come into our previous programs. So the one of the issues, and this is kind of why we're doing what we're doing at Hotbed, but one of the issues with a deck is it's a static piece of information that's true at the time that you receive the deck as the investor. And so if you say, I've got 1,000 customers, the investor doesn't know whether it's taken you a week or a month or a year or 10 years to get those 1,000 customers, and where that number's going to be next week or next month. And what investors really want to see is that speed of execution, or the speed of growth, or the speed of learning. So it might be that, okay, you did have 10 customers, but you couldn't convert them, and you couldn't convert them because actually the proposition was slightly wrong. And so you've gone through a pivot or something like that. And what investors are looking for is the kind of skills that the founding team have. So one of the skills that a lot of investors talk about is the ability to sell. How can you prove that you've got the ability to sell? And that might come down to the speed of growth, or the speed of customer conversations, and how quickly you can convert them, or how quickly can you be adaptive to feedback. It might be more a product-based metric. Priyanka, I don't know if you have a product metric for this, but if you're trying to prove that you can be agile and respond to feedback, like how quickly that goes into your product roadmap, or how quickly you can iterate on the product. So that might be a metric that you want to focus on as well.
Yeah, and I think a couple of things I'd add to that, Purdy, is around, if you are a product-based company, then you want to be focusing on stickiness and level of activity, right? So stickiness, obviously, if you can show repeat logins, or how often your ideal customer is coming back to your app and things like that, is stickiness. But also like activity levels, right? So for example, talking about your speed of learning or your rate of execution, if you're drawing out a graph of your usage, essentially, and you can show something where people got to a certain point in your app and you saw a lot of churn, as in, they stopped using it because, there was a lot of friction, or, they didn't find the feature they were expecting, or it wasn't working the way they were expecting. You learn that from your conversations, you fix it. And then, a month later, if you run the same graph, you will see that choke point is gone away, right? So you can actually visually show things like this, which again, if you take a step back in terms of, if you're early stage, and it sounds like most of you are, it's easy to kind of fall in the worry, or sort of the trap of, we're early and we don't really have numbers. To some extent, everybody has numbers, right? This is like the narrative you build with your numbers, the kind of storytelling you want to do. Because at that early stage, even kind of drawing out a graph that says, look, we had this thing where, on a daily basis, 15 people would log into our app. But then, with the telemetry in the app, we realized that when they get to this, payment functionality, almost all of them were leaving it like halfway through, right? They wouldn't go through with it. And we reached out to them and we understood what was going on. And we realized that there was, some problem with credit card security, or whatever it is, right? We fixed it. And then we kind of reran this. And now we can see that actually, our users don't drop out at that point in the workflow. So kind of just, side by side of, what it was before and what it was after, is again something that could go in your deck in terms of what's been the highlight of the last 30 days, last 60 days, but it can also go in your investor updates, literally saying the highlight of kind of this last month has been identifying, resolving, and shipping this big blocker we had in our product, and it has had immediate impact on the stickiness of the product.
Yeah. One of the things that we spoke about in the previous program on this topic was when people are just measuring revenue, they don't know where in the funnel something may have gone wrong because all they know is that they didn't get the revenue. And so actually mapping out the customer journey, so customer lands on your website, they're signposted to enter their email address to book in a demo call, then they have the demo call, then they get a follow-up email, then with a follow-up email is a payment link, whatever it might be, like the whole customer journey. And then you might be able to start seeing where some of those blockers are. So focusing on a KPI, which is actually right at the top of the funnel, which might be how many people are visiting your website to start with or something, might be better than measuring something right at the bottom, which would be revenue, because then you don't know where things may or may not have gone wrong. Would you agree with that?
Yeah, no, 100%, right? And I would say that that process to map out the journey as a framework is very helpful, whether you're trying to focus on product metrics or you're trying to focus on your sort of marketing to sales sort of conversion ratios and kind of building that GTM funnel, and trying to track kind of your revenue itself. Because one of the other things, which is really, really a myth, right, is that, like, if I don't have revenue, I don't have any metrics, which is not true. Because again, every investor understands that if you're just literally raising your first kind of professional investment round, or your first sort of $500,000 to $1 million, like a sizable amount of money to really build something, you are either pre-revenue or in early revenue, right? So revenue isn't the only metric, and quite frankly, is often the metric that isn't discussed the most. It's about, showing that if you are saying that you give me $1 million, pounds in this seed round, and our target as a company in 18 months is to be $1 million in ARR, it's your ability to kind of backtrack from that number, that how and show what are the stages that you're going to have to go through, both as a product and as a company, and pricing that goes along with it, to reach that $1 million in ARR, right? And that's the process to do that is, what you've outlined, Purdy, which is to say, if I need, say, I'm a B2B player, and every contract I do is 100,000 in value, and some kind of cybersecurity software service. So if I want to get to $1 million in ARR, I'm going to need 10 paying customers that's each paying me 100,000. To get 10 customers, I have to have a product pitch with, say, 50, because my conversion ratio is 5 to 1. And to have a product pitch to 50 customers, I should have I don't know, say 100 in the pipeline, right? So this is kind of how you have literally, using a B2B enterprise company, we've just built what's called sort of your entire metrics pipeline, which is to say that if I want to be at $1 million in ARR 18 months from now, starting next month, I must have 100 potential enterprise customers that I'm reaching out to. That 100 becomes 50, 50 becomes 10, and then 10 is what kind of gives me $1 million ARR, right? So that kind of, breaking it down from your end goal to what you need to start with is very useful for both, improving your product and being able to track sort of the monetization side of the business.
Yeah, that makes sense. And kind of just drives home the point that the investor outreach is also a sales pipeline, because you're using a similar approach to having that CRM, which could be on Google Docs, doesn't necessarily have to be a CRM that you're paying for at the stage, but you're going through that process of eliminating people and whittling it down to the interest. Last question from me, and then I'll take some questions from the cohort. You've briefly touched on this when you were talking about an investor update, but what happens if you just haven't had that good of a month, like you're not showing hockey stick growth, or the numbers aren't looking that good, but maybe it was because there was a bug that you had to fix, or there was, I don't know, some dynamics changed in the team, or whatever it might be. Like during this 6 weeks of the programming, when we're asking for updates, we're not expecting it to necessarily be good news every single time. But how do you approach that when you're trying to buy investor trust?
Be candid and be honest. That's kind of really the short, but I can assure you a very, very effective answer. I've used it for 20 years and it works because, again, I have never met an investor who only expected good news, but I have met plenty of investors who assume no news to be bad news. Right. So another way I can say this is that I've never met an investor who thought that, okay, if I haven't heard anything from my portfolio company, everything must be okay. It is exactly the opposite pretty much every single time, where if they don't hear from you, they're assuming, you know, the proverbial is hitting the fan, and you don't want to tell them, and starts creating mistrust, and what else is going on that you're not telling them about. So you have to be communicative even in the challenging times. How you do it is a little bit of an art and a little bit of a science. And what I mean by that is, if you are actually the kind of founder who's come to be known as a regular sort of communicator, then you can literally open an investor update saying, I've got challenging news to share this period. Or you can just say, the past month for our team at company X has been particularly challenging because of, oh, we had this big production outage, or we were very close to signing this deal and the customer pulled off, or we had like this really big customer we were relying on and they churned because their priorities changed. Whatever it is, right? If you've had a bad 2 weeks or bad month, you literally start by saying it's been a challenging couple of weeks. The one thing I would say is a huge missed opportunities. And as someone who actually, was building software to streamline all of this, I know this from having seen a good 80 to 100 founders do updates on our platform, is founders don't ask for help explicitly. And that's a huge missed opportunity, because pretty much as soon you've said what the challenge has been, you've got to go on and say, how can the investor help? Because not just that the investor is vested in your success, but it's just a normal human behavior. If someone's telling you they're having a shitty time, you kind of want them to say, and only if you could help me with this, I can come out of this really bad time I'm having, right? So literally put a section in your update where it literally is called how can I help, or how can you help, and very shortly and directly tell them if there's anything you think they can do, whether it's them or their network, whether it's an introduction, whether you want them to read like an RFP, and because you're so lost in how to do it, whatever it is. And if they can, they will. And
Yeah.
you'd be surprised at how many founders don't do it, and it's a huge missed opportunity.
I've also seen updates where founders put like the good, the less good, the ask, and then you get used to reading as the investor. Every single time you're going to get an update, there's going to be something that hasn't gone quite as well. And
Yeah.
maybe the severity changes month on month, but it sets the expectation that it's not like everything's going great, everything's going great, everything's going great. And then you receive one where it looks like it's got wobbly, and then that shakes a potential investor from wanting to invest. So that might be a way of kind of building it into the way that you communicate from the very beginning, even if the thing that didn't go quite as well was that you had to switch around the pricing. And it's never going to be absolutely perfect every single update.
Yeah, I mean, it's not a linear path, right? Like we all know as founders that building a company from the ground up is not a linear path. And as much as we know this, the investors know it as well.
Yeah. So we've got a question in the chat, but I'll start with the two founders with the hands raised. So Anka, you are first.
Hi, Priyanka. Thanks for sharing your thoughts with us. But just very quickly on where we are in our kind of journey. We are pre-revenue. We're a RegTech startup within the fintech space. We have the product nearly built. We're a couple of months away from the ready production version. We have very good initial traction, 20 plus clients engaged. I wanted to hear your thoughts around how how should we go about creating what our current valuation should be when we are discussing investments. We are pre-revenue. I just I feel there isn't a clear way to go around creating valuations. Just want to, hear your thoughts as to how you would go about it.
Sure. I mean, I'll share my thoughts both on based on my experience as a founder, but equally, I've been on the other side of the table as well as an angel investor and helped kind of being an EIR with some VCs. So there are 2 or 3 ways that a valuation of a company comes around. The first one you can say is you can start by simply saying, obviously you have to know how much you're raising. So let's use 1 million as an example. You can start by saying how much you're willing to dilute, right? So if you're raising 1 million and you want to dilute, for argument's sake, 20%, you're going to get both your pre and your post money, and that gives you just say a rough baseline to start with. What you then have to layer on is what's the sentiment in the market? Because if it's a founder market, then people may expect you to only dilute 15% for giving you 1 million. If it's a pro investor market, then dilutions up to 20, 25, 30% also happen, right? So so you are layering on what your own kind of ranges of what you consider acceptable as a founder with where the market is. And these kind of are and obviously the third angle, which I think sometimes is actually underutilized, is talking about what the forecast and the size of the opportunity is. Because the reason they're relevant is that if you're working in a space that's a massive market and it's like a massive sort of opportunity for a startup to capitalize, one of the things that's implied in that is that for a company to like really capitalize on it, it's going to have to go through multiple rounds of funding, right? It's not the kind of market that you're going to dominate with like, a couple of rounds or just like getting to a Series A and you're already starting to break even or things like that. So the idea that's implied by a large market, and if you're an ambitious company and you say we are out for world dominance, is that you'd actually be raising multiple rounds. And you want to kind of bring that into the mix because any sensible investor will not want to dilute you so much in the first round itself that it doesn't leave enough for the follow-on investors to come on in a way that the founding team and employees, early employees with stock options, etc., continues to stay motivated. So for a pre-revenue company where revenue is not in the mix of kind of how to value, it's really 3 things that you have to be really aware of so you can triage them and work the narrative to your advantage. One is, what's your own appetite for dilution? What does the market for your vertical and your industry look like? So be specific, right? So obviously don't use comparables from like an AI company, right? Because they'll be misleading for a rec tech company, even if you're a rec tech based on AI. So you want to see what the market sentiment is. And then eventually, like, what's the picture of the size of the opportunity that you can paint and get conviction on? Because the more bullish that picture is, the more bullish the valuation you'd be able to secure.
Cool. Thank you. There's some good ideas.
Thank you. Pina?
Yes, thank you very much, Priyanka, for all the super practical advice today. My question is, once we have this like 80 to 100 big list, target list of investors that we want to reach out, what should be the order? Like, should we approach more strategic ones to get better feedback at the beginning, or should we prioritize really practicing at first with a bit less strategic ones to get better for the strategic investors? So what will be your approach on this? Thank you.
So again, that's a very relevant and a very important question. I absolutely firmly believe that your pitch will evolve every time you actually pitch it to someone. Okay, so obviously there's a pre-season practice, right? So you can practice as part of like a program like this. You may have some advisors, some sort of co-founders, friends, anyone who'd hear you pitch. I'd say go and pitch and practice it. Then you kind of, when you're on the road, right? Like when your road shows have started, I would say you definitely want to pick a few that if you burn those pitches, they won't mean end of the world to you. Okay, because it is very different to pitch to a real investor versus, doing a pitch practice, even if, it's, I don't know, someone like myself, I've been a founder, I've been in it, it's going to be very different because at the end of the day, it's still a dress rehearsal, right? So you do want to have, I would say, anywhere from 5 to 10 pitches, which if they don't go your way, again, right, they're not the end of the world for you or your company. Once you've gotten to a point where you feel like your pitch in terms of the content, in terms of what you say about it, in terms of sort of confidence and how much you believe your own story is fairly stable and you're not finding it move a lot, from that point on, you do want to rank your long list. And where possible, you do want to start from, I would say, the top half. I'm not necessarily saying the top 10 because it is daunting to start with top 10 because there's still more for you to learn in terms of how to raise money. But you definitely want to start in the top half. And this is one of the things probably, investors may or may not tell you, but investors talk to each other. Okay, 100%. Just like founders talk to each other, investors talk to each other. There is investor grapevine. And it is quite rare or unlikely that, say, you go to a preference B or preference C investor because you don't think they're that prominent, they're not big a brand or something, and you get passed on by them. Then going to a tier A investor is going to be harder because there's a pretty good chance that the tier A investor knows that you've been passed on by a tier B investor for whatever their reason might be. Okay. And you don't necessarily want to be in that position. The other kind of a soft tactic, you have to be careful with this, but a soft tactic that does work is if you are in advanced conversations, everyone can define advanced as suits them best. But if you're in an advanced conversation with a known name and you're doing, kind of your raise with some salesmanship and good tact, you can say that, we are in advanced conversations with a known investor in this category or with an established investor in this category, which can help you build momentum in some of your other conversations and kind of sort of gently and slowly start building that FOMO around your raise, just to get more investors invested or just engaged, not invested, but engaged at that point, right? So practically, do a lot of practice, then find the investor pitches that you can burn and not feel, awful about. And then start with the top half, maybe leave the top 5 or 7 alone, but start with the top half. And you'll realize that even though, you might approach it in a very organized way, at the end of the day, you are dependent on their availability, their response time, right? So you will want to be running parallel threads because you don't want a week going by where you're just kind of waiting for people to, respond to your email.
Thank you. A couple of questions from the chat. So one of this will be based on your experience. What sales lead time would you expect for a new B2B software?
So that depends on like which B you're selling to. So as I mentioned, I come from financial services, come from fintech, and that can be anywhere from 6 months to up to 2 years. Right. So very much like if you're trying to sell to a bank, if you're trying to sell to a financial institution like a custodian, a clearinghouse, a trading broker, things like that, it'll take a long time. So 6 to 24 months, which is a pretty big range, but ultimately it will come down to what's the nature of the business you're selling to. But I'll share a couple of more practical things that will help you break this down for your own business. What you want to do when you start approaching them is very explicitly, if possible, in your first conversation itself, ask them what their procurement process is. And this is something, founders either don't feel confident doing or, overlook to do. And there's no reason to do that because any company that's buying, like a large company, especially if that's the kind of businesses you're selling to, will have a procurement process, and they'd be very willing to share it with you, because once you know that procurement process, then you can have the clarity about how many hoops you have to jump before you can actually, send them a commercial contract and expect someone to sign, and also kind of be prepared for it, right? So if I use my experience with financial services, one of the things that a lot of startups kind of, just kind of stumble into is things around, do you have the right redundancy in place? Do you have the right data protection in place? Do you actually have a policy document around your sort of information security and cybersecurity? These are like all the things that as startups, we think they're not important. We're building the product, we're selling it. Like this is all, it feels like administrative to us, or like too operational for us as founders to focus on. But if you're going to sell to a bank's not going to buy till they see all these things, right? But again, if you ask your contact there in terms of what's your procurement process and what are the 15 things that you need me to have as a vendor upfront, then it kind of, puts you in a good position, makes you proactive.
Awesome, thank you. And last quick question. I know we're just going a little bit over time, so we'll wrap up after this. It's quite a general one again, but maybe with your experience working in fintech, the question is, what are the important metrics to track and prioritize at the pre-seed stage if you're a fintech company? But maybe what were you tracking and demonstrating as a fintech yourself?
Yeah, so I mean, again, fintech comes in different shapes and sizes, right? So a little bit dependent on what the business is. So I'll probably share from a pre-seed perspective what's really relevant. If there are founders in this group who are targeting and have the aspirations of raising what I call an institutional seed, so actually like, going to a VC and raising a seed round that's north of $1 million, then I definitely recommend getting to some form of early revenue, whatever it is, whether it's on a highly discounted price because your product is not fully built, or you've given somebody 3 months of subscription free and then they're going to start paying. But start having from pre-seed to seed, start having some kind of revenue in the mix. And that's kind of, one of our hard lessons, that when we were going from sort of angel and family offices to an institutional VC raise, amongst other things, but like sort of one of the things that we could have focused on more and would have helped our case was kind of having that revenue in the mix early on, because even though a lot of VC websites will say that, seed, we're not focused on revenue and we're looking to back founders at seed stage. And that's kind of the language you'll see in all their investment thesis documents and all their marketing collateral. That's actually just not true. So again, I'm going to say this as a founder and not as an investor. As a fintech, then more so, you want to kind of have some kind of revenue in the mix, which can then be extrapolated to really reinforce your startup's ability to monetize.
I really appreciate that. Thank you so much for joining and for your time and all that practical advice. I did put Priyanka's LinkedIn profile in the chat, but if anyone wants to reach out to you any other way, what's the best way for them to do so?
LinkedIn is, definitely the best. I'm fairly active on LinkedIn and try to respond to all my inbounds. So I think that would be the most effective. And if someone's interested in a longer conversation, then we can definitely kind of get off of LinkedIn and go to emails or something.
I appreciate that. Thank you so much. We will let you go, Priyanka. For the founders in the room, the next session is on Wednesday at 11 a.m. I've just posted our WhatsApp group link. If you would like to join the WhatsApp group, it's not mandatory that you do so, but we will post updates in there as well. So video replays from sessions or reminders or extra content that might be useful for you. It's also a place where you can connect with your peers in between in-person sessions. But otherwise, the founders, we will let you go as well. We'll follow up with details about the weekly growth updates within the week. There will be a platform that you need to log into to do that, which will take place on Friday. If you have any other questions, you've got mine and Em's email addresses and all the onboarding material that we sent you. So just drop us an email. Thanks so much.
All the best. Good luck.
Thank you.
Thanks, Priyanka.
Bye.